Hello everyone, we completed up to provision number 9 from Directive 2 in the previous video. So in this one we'll go up to margin lending. So number 10 is conditions for adjustment in loan loss provision. Loan loss provisions may not be adjusted except in the following circumstances, and the circumstances are: the very first one is in the case of loan write-offs. The second is when loan payments are made in installments or partially, the loan loss provision corresponding to the payment extent is maintained according to the loan classification. Similarly, if the principal and interest payments of the restructured or rescheduled loans are regular for 2 consecutive years, if the loan is settled, if the deficiencies found during supervision are rectified by the licensed institution and the relevant supervisory department is convinced. Now, provision 11, acceptance of non-banking assets, loss provision and auction sale. If a licensed institution is unable to recover a loan, it can sell the collateral held as security to collect the remaining principal and interest. In the process of debt recovery, if the collateral is auctioned and not sold, the institution must acquire it itself. When acquiring, the collateral must be valued at the prevailing market price or the total receivable amount up to the day before acquisition, whichever is lower. So if the market value of the collateral is less than the receivable amount, the deficit should be recorded as an expense in the profit or loss account of that financial year and noted in the accounting policy. However, until the non-banking assets adjustments are fully reconciled, the interest portion of the receivables cannot be recognized as income in the profit or loss account, and such amounts should be transferred to the non-banking assets loss management account. Similarly, licensed institutions must maintain a provision for 100% loan loss from the date of realization of non-banking assets. In the event of the sale of non-banking assets, a necessary reconciliation of the loss provision created for such assets must be conducted. Licensed institutions must adhere to the following when acquiring collateral as non-banking assets and auctioning the recognized non-banking assets. So the very first point is, when acquiring the collateral property of a client who has an outstanding loan amount exceeding NPR 1 million as a non-banking asset, the concerned party must be mandatorily included in the blacklist. However, in the case of loans up to Nepalese rupees 1 million, the respective bank or finance institutions can decide whether to include them in the blacklist. Before auctioning non-banking assets in the name of the organization, a realistic valuation should be conducted by an independent appraiser. However, the same appraiser cannot conduct the valuation of the same asset more than once consecutively. Next, in relation to the collateral, security or non-banking assets auction, licensed institution must make transparent and clear arrangements for selling, ensuring the protection of the interest of the banks and financial institutions. When accepting non-banking assets in this manner, the entire security property that could not be auctioned must be taken as only partial acquisition is not allowed. Similarly, the acquired property must be sold as soon as possible. If it is required for the licensed institution's own use, it should be approved by the board of directors and the bank should be informed. When returning property acquired as non-banking assets to the collateral owner, the owner before it become a non-banking asset, it should be returned at the value at which it was recorded as non-banking asset or the remaining debt amount, principal and interest, at the time of return, whichever is higher. This directive will not be considered an obstacle to returning the collateral or security through mutual agreement between the concerned institution and the collateral owner. Next provision is guidance to be followed when developing bylaws related to loan write-offs. So, licensed institutions must prepare criteria for determining which loans are unlikely to be recovered and formulate regulations through their respective board of directors to write off such loans and implement them with approval from this bank. The licensed institutions can write off loans after completing the following procedures. The first is the loan must have been classified as bad and 100% loan loss provision must have been made. The process of collateral auction according to prevailing laws and policies for loan recovery must have been completed. In cases where the collateral auction has not resulted in a sale, the collateral must mandatorily be acquired. Now, debtors and parties related to the debt must be included in the blacklist of the Credit Information Bureau Limited as per the instructions of this bank. However, when writing of loans of less than Nepalese rupees 200,000 as per the provisions made under subsection 1, the provisions of subsection 2b and 2c, and this arrangement will not be mandatory. For return of loans, at what level or by whose decision were they approved? How was the valuation of the collateral provided for such loans conducted? Additionally, what efforts were made to recover such loans? The justification for going into write-off, among other things, should be mentioned on record. Similarly, a separate loan recovery unit should be established for the recovery of written-off loans, and the concerned institution must continuously strive to recover such loans. A separate register must be maintained for the updated details of the written-off loans. The details of the loans written off during the current year, including the points mentioned in subclause number 4 above, must be mandatorily mentioned in the annual report. In the absence of clear legal provisions and guidance or directives regarding loan write-offs, to prevent the possibility of excessive authority resting with the decision makers during the waiver or write-off process, a clear and transparent policy arrangement must be established considering the potential future impacts of loan waiver or write-off. And the details of the return of loans must be sent to the relevant supervision department and the Credit Information Center Limited within 15 days from the end date of fiscal year. Next provision is regarding the implementation of the esteemed Supreme Court decision. So, regarding the collateral and auction related activities undertaken by banks and finance institutions, an order has been issued by the Honorable Supreme Court on 2072-916 directing all banks and finance institutions to immediately implement the following instruction. Therefore, this directive is being issued to enforce those instructions. The guarantor who places as collateral security should clearly define the limit of the amount of loan they are guaranteeing, ensuring that the guarantor's liability is limited to that specific amount by having a separate document for the guarantor. Prepare the contents and conditions written in the documents related to loans and guarantees between the debtor in the bank or the guarantor in the bank in an easy readable format. Similarly, do not execute documents directly or indirectly in a manner that imposes a greater liability than what the guarantor has agreed to. The amount corresponding to the guarantor's agreed responsibility will first be collected from the concerned debtor. If it cannot be collected from the debtor, it can be recovered by auctioning the collateral provided by the guarantor to the extent of the guaranteed amount as mentioned in the terms of guarantee. Before accepting the property shown by the guarantor as collateral, legal procedures must be completed to assess whether the property is tangible or intangible, and its actual value must be determined and disclosed. No recovery should be made from the guarantor's property for liabilities of the debtor other than the amount agreed by the guarantor. Next, the process of recovery from the guarantor's security will only commence if the amount owed by the debtor cannot be recovered. If the guarantor brings in the guaranteed amount at any time, the property held as security will be released upon receipt. When a guarantor's pledged security needs to be seized to recoup the principal amount owed by the borrower, the valuation of such property should take into account assessments conducted by local individuals, technical evaluations, prevailing market value, value determined by the Land Revenue Office, and the value set when the security was accepted, with a standard created and applied for this determination. The value of collateral should not be set by devaluing without a real and clear basis or reason. If the property given as security by the guarantor needs to be auctioned, notification will be given to the guarantor with a specified time frame to deposit the amount agreed upon. If the guarantor fails to deposit the agreed amount within the specified notification period, a notice will be published for the auction of the collateral property, informing the guarantor as well. The bank must prepare and implement separate regulations, procedures, or guidelines regarding the process and procedures to be followed during the auction of the collateral property. If the amount owed as per the bond is deposited either before the auction date or within a specified time after the auction, the collateral will be released upon receipt. Similarly, respected Supreme Court's decision dated 2073-78 has issued the following directives to be implemented by all banks and financial institutions, and thus this directive is issued to ensure the implementation of those instructions too. The very first is ensure the accurate valuation of the debtor's assets at the time of taking the loan. Arrange for the auction and sale of the secured assets according to the prevailing market price at the time of the auction. Recognize that not every debtor has defaulted with the intention of fraudulence. Therefore, initiate a debt recovery process with respect and empathy towards the debtor and their family, ensuring it is conducted fairly. Make necessary arrangements to ensure that the debt recovery process does not adversely affect the social status, dignity, and the respect of the debtor's family members. Avoid repeated hikes in interest rates contrary to the agreements made at the time of taking the loan. Now, next provision, number 14, is provisions relating to credit, sale, purchase or repurchase and takeover. The banks and financial institutions having no adequate capital fund prescribed by this bank shall not be allowed to purchase any type of loan, credit to take on discount, and to engage in credit sale, purchase or repurchase or takeover without prior approval of this bank. Banks and institutions with sufficient capital as determined by this bank may engage in CS, CP, RP and TO mentioned above under the following conditions and restrictions. The conditions are: banks or financial institution must maintain the capital as determined by this bank even before undertaking CS, CP, RP and TO. Banks or financial institutions must clearly provide for credit sale, credit purchase, credit repurchase and takeover in their credit policies, otherwise such transactions will not be permitted. Next is CSCP, RP and TO activities are not allowed in the last month of the fiscal year. Similarly, while carrying out transactions of credit purchase, the purchaser shall have to purchase the right to recover such credit from the customer. For that purpose, consent of the concerned customer shall also have to be obtained. And for this purpose, the purchaser of the credit shall have to account the credit so purchased in loan and advances subtitle under the concerned title in its account. Credit shall be purchased only after having collected comprehensive description of the terms and conditions of the credit. The bank and financial institution purchasing the credit shall have to maintain the loan loss provision according to the prevailing condition of the loan classification and loan loss provision. Similarly, banks and financial institutions purchasing a loan must include the following details in the loan file: the date the borrower took the loan, type of loan, repayment status, past loan transaction status, status of the guarantor, loan classification status, and details of any discrepancies noted in the external auditors and this bank's inspection report, if any. Additionally, this provision will also apply when a licensed institution acquires a loan swap from another institution. And the last is, while purchasing a credit, the documents showing the basis to be ensured that such credit is secure and is profitable for the institution have to be enclosed and updated in the loan file. Now, half-yearly statement of CS, CP, RP and TO transaction shall be sent to the concerned supervision department of this bank within 15 days of the completion of the half-yearly period. Next, in the event where there is a condition that the selling institution shall repurchase the credit if the purchaser institution fails to recover the credit while entering into transaction of credit purchase and sale, the institution purchasing the credit shall, until the selling institution repurchases the credit, have to show such credit in its balance sheet as a contingent liability, and such contingent liability shall, for the purpose of calculating capital fund, be accorded only 20% risk weight. In case where loans or deposits given or kept with other banks or financial institutions under interbank transactions cannot be recovered in time, the banks or financial institutions that provided the loan or deposit may purchase the loans provided by the borrower or depositor bank or financial institution with the consent of the relevant customer and prior approval of this bank, following the procedures mentioned below. The procedures are: when purchasing a loan, the purchase must be at least double the total outstanding principal and interest amount. Loans must be purchased and sold as they are by mutual agreement between the buying and selling institutions. There shall be no partial payment of loans when purchasing loans. Number 15 is prohibition on advancing loan and accepting deposit based on financial guarantee. Banks and financial institutions established and operating domestically shall not be permitted to provide loans or accept deposit based on financial guarantees issued by any bank or financial institution. However, commercial banks shall face no obstacles in issuing guarantees and letter of credit against the guarantees of financial institution in categories B and C. Next provision is the provision relating to deposit and loan transaction. No licensed bank or financial institution shall be allowed to deposit amount or enter into loan transaction with institutions which are engaged in deposit mobilization and loan transaction in accordance with prevailing laws other than the Bank and Financial Institution Act 2073. Institutions conducting saving mobilization and lending transactions in accordance with prevailing laws other than the Banks and Financial Institution Act 2073 will not be impeded by the provisions of the aforementioned subclause 1 while placing deposits in licensed bank and financial institutions or taking loans against deposit receipts from these banks. However, when taking a loan against a deposit receipt, such a loan must be provided only by the same bank or financial institution where the deposit is held. And the last is, licensed bank and financial institutions may, while advancing loan, placing deposit receipt, advance credit or advances subject to the credit policy, directives of the institution and without lessening the interest rate than the coupon rate. Now, the last provision in the video. Loans to be advanced on security of shares in the nature of margin lending. With regard to the loan, in the nature of margin lending to be advanced from a bank or finance institution on the place of shares of the companies listed in the list of Nepal Securities Exchange Market Limited,
The loan may be advanced having followed the following terms and conditions. The first condition is the loan must be disbursed only after evaluating and filing a lien on the shares placed as collateral in accordance with Section 2. In the case of loans disbursed in this manner, when valuing shares kept as security, only up to 70% of the average of the last 180 working days closing price published by the Nepal Stock Exchange Limited or the prevailing market price of the shares, whichever is lower, can be disbursed as loan collateral. Shares used as security for such a loan, once disbursed, cannot be revalued to establish an increased credit limit or to provide an additional loan based on such revaluation. Similarly, if there is a decrease in the collateral value due to changes in the market price of the shares, the relevant bank or financial institution must monitor this value and notify the borrowing customer for additional collateral. Licensed institutions should clearly specify in the relevant product paper the arrangement for making a margin call and liquidating shares if additional security is not maintained. When making a margin call, the number of rights and bonus shares obtained from those shares, even if not listed, can be counted in the placed share count. The tenure of loans disbursed in this manner will not exceed 1 year. Borrowers utilizing margin type loans with share collateral can renew such loans if they have paid the entire principal interest and the loan is in good standing. However, this provision will not apply to share collateral provided for loans disbursed for the purpose. The concerned bank or finance institution must update relevant information, statistics, and details in the respective loan files concerning the purpose of the loan. Such shares taken as additional collateral will remain as only supplementary security. Next, shares of the following institutions cannot be used as collateral for loans. Banks and financial institutions that have been declared problematic by this bank or have not maintained capital reserve ratios as per directives. Institutions with negative net worth. Similarly, institutions delisted by the Nepal Stock Exchange Limited. Institutions that failed to conduct their final audit even after 1 year from the end of the fiscal year. Institutions that have been continuously in loss for the past 3 years. Institutions that have not been operational for at least 1 year since commencing business. Institutions that have not held a general assembly for the past 3 years. And institutions that do not have trading value for at least 250 days. Next point is banks and financial institutions can only extend a margin nature loan up to a maximum of 40% of their core capital. For this purpose, core capital refers to the primary capital determined based on the internally audited financial statements of the immediately preceding quarter. The amount equivalent to the loan disbursed beyond the specified limit should be deducted from the core capital fund by the licensed institution. Securities transactions conducted by securities business persons must comply with the prevailing legal provisions and follow the policy or directives of the Nepal Securities Board. Such securities business persons will be granted approval from this bank upon the recommendation of Nepal Stock Exchange Limited as per the provision in Section 76 of the Nepal Rashtra Bank Act 2002. Now the last one. Regarding providing loans against shares of listed companies in the securities market, banks and financial institutions must clearly include this in their credit policy or guidelines and complete all processes as rigorously as with other types of credit. These credit policies or guidelines should clearly specify analysis of the fundamental indicators such as the price earning ratio, dividend yield, price to book value, and dividend payout ratio of the shares used as collateral. Next point, regarding shares mortgaged by banks and financial institutions. Licensed bank and financial institutions are not allowed to seize their own shares to recover a loan.